Welcome back to Self-Invested. My name's Lemuel, and in this video I'm going to have a look at Proportunity and their recent announcement about a 0% deposit mortgage they're launching. I'll discuss how it might work, whether it's a good deal for buyers, and compare it to Help to Buy and the shared ownership schemes. I think this is going to be an interesting one, so I hope you enjoy it. If you do, then make sure you give this video a like. So what is Proportunity? Well, it's a fintech or financial technology company that offers equity loans that work in a similar way to the Help to Buy equity loan. But the reason they've been in headlines recently is because they announced they're launching a new 0% deposit mortgage. The benefit of a 0% deposit mortgage for home buyers is that they can secure a mortgage without putting down any money. Usually, the minimum you can put down is 5%. So if you're buying a property for 270,000, you would usually need to put down a 5% deposit, which is £13,500, and also have a 95% mortgage, which is 256,500. With a 0% deposit mortgage, however, you wouldn't need to find that £13,500. You would be able to secure a £256,500 mortgage without a deposit. But as you'll quickly see, it also means that you won't be able to afford as much. This is because although you wouldn't need a deposit, it's not likely the lender is going to lend you more money for your mortgage. Lenders usually lend you a maximum of 4.5 times your salary, which in this case would mean that you would have a salary of 57,000, and the maximum that you would be able to borrow with that salary is 256,500 pounds, which is also the maximum you'd be able to spend with a 0% deposit mortgage, compared to 270,000 if you had a 5% deposit. So as you can see, the main benefit of a 0% deposit mortgage is that it allows you to buy sooner. You don't have to wait until you save the deposit. But I think Proportunity's 0% deposit mortgage is going to be more than just a mortgage and will actually increase the amount people will be able to buy with. So what do I think the 0% deposit mortgage will look like? Well, I think it will be a combination of a 0% deposit mortgage and Proportunity's equity loan, which allows you to borrow up to 25% of a property's value. Based on the example I gave earlier, this means somebody with a 57k salary would be able to increase their spending power from £256,500 to £342,000. That's an increase of 33%. So how would this all work? Well, firstly, I think Proportunity will offer a traditional repayment mortgage, which will be for a fixed amount, approximately 4.5 times your salary, and come with a fixed interest rate for a set period. In addition to this, however, I think Proportunity will offer their equity loan, which will act like a deposit to increase your spending power. This equity loan is something Proportunity already offer, and it allows you to borrow up to 25% of a property's value in addition to your mortgage. If a 25% equity loan was used with a 0% deposit mortgage in the example I gave previously, the mortgage of 256,500 would make up 75% of the property's value, and the equity loan will cover the remaining 25% at £85,500, meaning that you'd be able to afford a property up to the cost of £342,000 without having to put down any money. As you can see, this is a pretty attractive offer to prospective buyers with little or no deposit. So isn't this a risky investment for Proportunity, since they're covering 100% of the property's value, taking most of the risk, and stretching the buyer's affordability to around 6 times their salary? Well, in terms of the buyer's affordability, with the equity loan, the monthly payments will only be interest payments, not capital repayments. This means the monthly payments will be cheaper. For example, if an £85,500 equity loan had a repayment term of 25 years and an interest rate of 5.99%, then the monthly capital payments would be £550. But if the monthly payments were interest only, it would only cost £427. That's £123 less each month, putting less strain on the buyer's affordability. But the greater reason I think Proportunity is willing to take this risk is because they are very selective about the properties they invest in. According to their website, they make their own assessments on how much a property is worth, which all lenders usually do. But Proportunity has developed its own algorithm which finds best value homes and determines if a home is good value. This means, in their own words, that they're quite choosy about the homes they provide a loan on. So they will avoid lending money on properties they view as risky investments. This reduces the risk for Proportunity and makes them willing to take on the risk of offering a 0% deposit mortgage. So is this a good deal for home buyers? Well, I think it's good that Proportunity is selective about the properties they invest in, because this means buyers are less likely to buy a property that ends up going down in value. But I think the interest rates for the equity loan are high compared to similar schemes such as Help to Buy and shared ownership. According to the website, the interest rate for the Proportunity equity loan ranges between 5.99% and 8.49%, depending on how good an investment or undervalued the home is. So the best rate you can get is 5.99%, which is fixed for 5 years. This is pretty high compared to current mortgage rates, even though they're increasing, and the Help to Buy and shared ownership schemes as well. However, after 5 years, the Proportunity equity loan moves to a variable rate, which is the Bank of England's base rate plus 9.99%, which would currently work out to 11.24%, very high. I think the intention is that at the end of 5 years, the homeowner pays off the loan in full before the higher rate kicks in. But this isn't as easy as it first appears, as I covered in my shared ownership repayment video, which I'll link to above my head now. For example, with the £342,000 home I mentioned earlier, which was bought with a 25% equity loan of £85,500 and a mortgage of £256,500, if the value of that home was to increase by 20% after 5 years to £410,400, then the equity loan at 25% would have increased in value to £102,600. If the £256,500 mortgage was on a fixed rate for 2.5% for 5 years, which is probably lower than what's currently available at this time, then the outstanding mortgage would have reduced to around £217,000 after 5 years. This means the share of the property you owned would have increased from nothing, because you didn't put any money down with a 0% deposit mortgage, to around £90,000, which is the amount left over of the property's value when you take away the remaining mortgage and equity loan amounts. Now, this is not enough to repay the equity loan in full, which was just over £102,000. So you would have had to save an additional £12,000 over this period to pay off the remaining amount, which is plausible. But the bigger issue, however, is that to use that £90,000 of equity you've built in your property, you would need to secure a bigger mortgage of £307,800. In order to secure this bigger mortgage, you would need your salary to have increased from £57,000 to over £68,000, which is also an increase of 20%. Now, this example may or may not seem plausible to you, but there are a few things that you should consider. Firstly, the bigger the increase in your property's value, the more expensive the loan will be to repay. So it actually works in your favor for your home not to increase in value too quickly in the first 5 years. An increase only works for you if you plan to sell and move at the end of 5 years, because the share you own in the home will increase in value, giving you more money to buy another home. Secondly, the lower the interest rate and the shorter the mortgage term, the better, because the higher the mortgage rate and the longer the mortgage term, the less capital you will pay over those first 5 years, and the more cash you'll have to add to your mortgage when you remortgage to repay the loan. Thirdly, if you don't pay back the loan in full after 5 years, then you'll end up on that hefty variable rate, which is the Bank of England base rate plus 9.99%. So how does the Proportunity equity loan compare to Help to Buy and shared ownership? The Proportunity homepage has a comparison between the three schemes, but it's not that detailed, and unhelpfully states that it's not comparable to the shared ownership scheme. But I think they are all forms of shared equity. I've even made an in-depth video explaining why Help to Buy is essentially a form of shared ownership, which I'll link to above my head right now. And it's worth watching to see why Proportunity's equity loan is also similar. Anyway, I'm going to do a quick comparison here to see how the Proportunity equity loan compares to the Help to Buy and shared ownership schemes. If you want me to make a separate video with fully worked examples comparing the three schemes, then make sure you give this video a like and leave a comment down below letting me know. So firstly, I'm going to compare the purchase price of homes under each scheme. Proportunity states it will help you find a fair value home with its technology, so it's unlikely you'll pay over the odds when you buy a home with them. I think this is true because Proportunity won't lend on properties they think are overpriced. Help to Buy homes, on the other hand, are new builds and are usually sold by developers trying to maximize profit. So there's a good chance you'll pay a premium for buying a home with Help to Buy. With shared ownership, however, the value of homes is determined by a chartered surveyor. So there's a good chance you'll pay a fairer value with the shared ownership scheme. Secondly, I'm going to compare the cost of the equity or share of the home you don't own over the first 5 years and afterwards. With Proportunity, the interest rate over the first 5 years is between 5.99% and 8.49%, after which it moves to the variable rate, which is the Bank of England base rate plus 9.99%. With Help to Buy, the interest rate is 0 for the first 5 years, then is 1.75% and increases with inflation plus 1% or 2% depending on whether you're on the old scheme or the new scheme. With shared ownership, the rent for the share of the home that you don't own is capped at 3%. Then it may increase with inflation plus 0.5% or 2%, depending on the terms and conditions that you have with your housing provider. This, in my opinion, means that the cost of the share you don't own works out to be vastly cheaper under the Help to Buy scheme and the shared ownership scheme. Thirdly, I'm going to compare the types of homes that you can buy under each scheme. With Proportunity, you can buy new builds and existing homes. However, I doubt you'll be able to find many eligible new builds because, as I mentioned earlier, they are usually sold at a premium, which I don't think Proportunity will consider fair value. With Help to Buy, you can only buy new builds, and with shared ownership, you can buy new builds and resold shared ownership homes. Lastly, I'm going to look at the cost of repaying the loan or buying the share you don't own for the three schemes. With Proportunity, if you repay the loan after 5 years, there doesn't appear to be any repayment costs. It's not clear if you need to pay for a surveyor to value your home or to hire a solicitor to do any legal works for repaying the remaining loan. If you want to repay the loan before the end of the 5 years, however, there will be an early repayment charge of between 7 and 1%. With the Help to Buy loan, there's no restrictions on when you can repay the loan that I'm aware of, but there is an application process to repay the loan which requires a solicitor and a surveyor. It's likely the cost will be a total of around £1,000. The cost of the staircase and your ownership with shared ownership is also similar to repaying the loan with Help to Buy, so will cost around £1,000 in fees as well. From this quick assessment, I think shared ownership is comparable with the Proportunity equity loan, and in my opinion, is actually a better deal than the Proportunity loan, even with the cost of staircasing. And it's not even clear if there is or isn't any surveyor or legal costs for repaying the Proportunity equity loan. But what do you think? Do you agree or disagree with my assessment? Do you think shared ownership is a better deal than the Proportunity equity loan? Let me know down in the comments. And remember, if you want me to make a more in-depth video comparing the three schemes, that's the Proportunity equity loan, the Help to Buy scheme, and shared ownership, then make sure you give this video a like so I know that there's interest in it, and let me know down in the comments. Anyway, that brings us to the end of this video. I hope you enjoyed it, and if you did enjoy it, then make sure you give the video a like, and I'll see you in the next one. Take care. Bye. I am not a legal or financial expert. The views expressed in this video are my own opinions based on my understanding of the topic. They do not constitute and are not a substitute for professional advice. If you need advice, you should seek a suitably qualified professional.